Welcome back. Suprajit Engineering is a stock and the company on our radar. MK initiated coverage in this stock earlier this week. It was a buy recommendation. They're forecasting a revenue growth of 25% over FY22 to FY25. To discuss the business outlook, we're now joined by Mr. Ajith Kumar Rai, founder and chairman of Suprajit Engineering. Mr. Rai, morning, and thanks for joining in. This is Rima here. Wanted to understand your outlook for exports. Exports, I believe, is about 40% of your overall revenues. We've heard from the likes of large U.S. auto companies like Ford saying that, they're going to face an impact of nearly $1 billion in terms of cost, far more than what they were earlier anticipating. And the fear is that it's not going to be restricted just to Ford. Maybe others like General Motors, etc., could also be facing an impact, due to weak demand as well as inflationary costs, still supply shortages, etc. Can you talk about the export outlook and what is it that you're seeing in terms of a demand from U.S., Europe, and your key clients?
Good morning, and thank you for having me on your channel. Yes, globally, there is a threat of recession, which is very true and very, very imminent, actually. But what I have been hearing from my own marketing and business development team, particularly in the automotive space, is that right now, there is a huge backlog of requirement from the customers. Thanks to the chip shortage and production constraints, etc., both due to COVID and also due to supply chain issues, there has been a tremendous vacuum in the supply chain at the consumer end in terms of the distribution setup. So today, every car, I was just talking to our president of US this morning, and he said that any car that has been manufactured here today has already been sold in some distribution channel. So there is a good demand in there, but there is a manufacturing constraints. I think it's a question of time when these manufacturing constraints relating to the components and chip shortages are overcome and the supply chain gears up to the requirement of OEMs. I think those pent-up demands will be there, and I think that would add to the tailwind that we are facing. Our tailwind that we are facing is also due to the new businesses that we are getting. So when you're adding 1 plus 1, I think it's going to be a very strong pipeline for us going forward.
Facing any production manufacturing constraints, and could you tell us the quantum if yes?
No, we do not have any manufacturing constraints. Of course, we are still having certain constraints regarding the IC chips because some of the assemblies where we use the IC chips, we have certain shortages. But for us, it is not a big problem. I think it is a problem for the manufacturers, like the automakers themselves, which is a major issue, I think.
Okay, so could you tell us then what is the kind of growth that you're looking at, Mr. Rai, for the full year? If you can tell us, the note that Rima was just pointing out said around 20 to 25%. Do you think that's a fair estimate?
I mean, we don't really give such a long-term futuristic numbers. All we have been guiding consistently has been that we will probably outperform the industry by about 10%. I think which is easily doable for this year. What is also important is that this year we'll have a big spike in our growth thanks to the acquisition of LDC, which will add another nearly 800 crores of business to us in this financial year. And from the last year's position for the next 5 years, because of that spike, that kind of a growth is possible. Also due to the fact that we believe that once these chip issues are resolved fully, there will be a good volume growth as well in the US market. Although European market is somewhat tepid due to various other reasons.
Okay. Hi, Mr. Rai. Good morning. I wanted to speak about your manufacturing because we understand that you have moved your low-value, high-volume manufacturing to Indian plants and the more specialized procedures being done overseas. So could you give us a sense of what kind of savings this has been in terms of costs?
Just to give a little larger perspective, we had 5 years ago acquired Westcon with its plants in the US and Mexico, and now LDC with their plants in Mexico, Hungary, and China. What we are currently doing is what is best for the group in terms of restructuring. In the process of that restructuring, we are finding that the synergies and better values of respective plants will have to be respected, and we want to reorient our manufacturing lines in line with the strengths of respective plants. You are right, mass manufacturing has certain advantages in India, and I think we are leveraging that by approaching to the customer saying that, we'll be able to give them better value. by moving some of those businesses to India. But it is not across the board. It's ultimately customer-centric. If customer is preferring a better value, having the supply chain issues of, supplies from India to, say, Europe and US, which is also a challenge today, they take the call, and accordingly we work. But yes, there is a move, in fact, particularly in the automotive as well as non-automotive businesses, larger volumes of, wherever the volumes are larger, the opportunities to do it in India with a better margin does exist, and we are leveraging that.
Okay, and since we're talking about this lowering of costs, can you tell us what it will really mean for your margins going forward, and how much of an improvement do you see? Because for Q1, we saw around 480 bips margin compression as well.
Yeah, I think some of the things that will happen as we go forward because of this restructuring and reorientation of manufacturing is that it will add on to our margin. But of course, as you rightly said, we have also lost some margins thanks to the steep increase in energy, material, and other costs. So it will offset some of those costs. So we'll continue to be able to deliver the margins that we enjoyed historically going forward once these restructuring and all is completed.
What would that number be, and by when do you think you will be able to achieve that?
See, actually, if you take ex-LDC, without LDC, we are still at about 13.5% margin. Our guidance has been 14 to 15%. So we are very much there in terms of without LDC. LDC being a new acquisition, we have given a detailed brief on this, saying that is adding a little bit of stress on the margin, but there is an year's pain which is required to re-strengthen and restructure LDC. Once that is done by end of next year, LDC margins, along with the India margins, will be easily in the double digits.
So FY24 margins on a consolidated basis will be in double digits, right?
Yes. And end of next year, we'll be very much there. Probably even before that, yes.
Okay.
All right, Mr. Rai, thank you very much, sir, for joining in and for explaining to us where things stand right now. We're going to take a very quick break. As we do that, here's some great news for investors. You can now track U.S. market action real time on Money Control. All you have to do is log on to the Money Control website or app, and you can stay informed about all that matters in the global markets.